Remember where we are coming from? I said use 7 steps to do your consolidation, draw the structure, calculate the consideration, calculate the net asset, the open NCI, the goodwill, then prepare the template before you consolidate the 7th step. And this consolidate step should be done in these 5 steps. The 5 steps is to remove subsidiary and share capital of the subsidiary, investment in subsidiary and share capital of the subsidiary. Once you've done that, you make all the necessary adjustments, be it intracompany transactions, fair value adjustment, all sorts of adjustments. You need to do that. Then you combine all asset and liability 100%, put the group return earnings, calculate that, and calculate NCL and put it on your balance sheet as well. So these are the 5 steps that you've been using to do the consolidate stage. And I've been trying to explain the various forms of adjustment that you have to make. In the last video, we looked at intra-group transaction adjustment. That's what we have looked at. And today, we're starting with fair value adjustment. Now, there are other forms of adjustment that you need to understand and be able to make. And don't go beyond this 4, right? But let's quickly look at fair value adjustment. And I will start with PPE. That's one of the popular one that you always get. Yeah, non-current asset. And why are we talking about non-current asset, or why are we even talking about this fair value adjustment? Fair value adjustment is critical because, remember, in consolidation, on that acquisition date, there is a requirement, which is that you must value all assets and liabilities of the subsidiary at fair value. This is compulsory. It must be valued at fair value. However, most times the fair value of those assets and liabilities are usually their carrying value. So we might not do adjustment. However, this is important because in a situation whereby that is not the case, where the fair value of PPE or fair value of liability is not the same as the carrying value, then you need to make an adjustment. And that is why we're talking about this. So we need to learn how to make such adjustments when we have a discrepancy between the carrying value and the fair value of any item on the statement of financial position of the subsidiary. Yeah. So remember that non-current asset can either be a depreciable asset or a non-depreciable asset. And I'm breaking it down into these 2 categories because the impact is different. Yeah, and it's simple. It's just your usual debit and credit, like I always tell you, right? Take for instance, if current value of NCA is 50 on acquisition date and its fair value on that day is 53, what you are saying is that you must use this figure and not this figure because this guy has been acquired on that day, fair valuation must take place, and which we need to make acquisition date adjustment. So the first rule for this fair value adjustment is on acquisition date. Acquisition date. Right. So on acquisition date, we are saying the asset should be 53 and not 50. So which means you have to debit non-current assets for that extra of 3, and the credit goes to the retained earnings on acquisition date of 3. And you can see that this adjustment is critical because you need this impact on goodwill because goodwill will be impacted. Remember, goodwill is consideration less the fair value of asset acquired. So net asset will have gone up by 3, and that will affect the goodwill figure that you get because that will reduce the goodwill figure, right? And this is usually straightforward for a non-depreciable asset. Well, because it's just this rule 1 and it stops there because there is no depreciation on these 3 extra that we're talking about. That is straightforward. Which means once you make that adjustment for goodwill, you only need to take note of it on the balance sheet, on the statement of financial position, when you are adding your assets and liabilities together. And that is why I always like you to do this adjustment before you start adding your asset and liability so that you take care of such items first. And we'll practice an example like that soon. Let's look at, so this is for non-depreciable asset. For a depreciable asset, it will be different. You first do the number 1, which is this one, right? Number 1 will be done. However, there will be depreciation impact after because this extra 3 will now need to go through depreciation depending on the useful life of the remaining useful life of the asset in question. You have to calculate depreciation. Usually, the question will make it a straight line depreciation such that it is simple and straightforward, right? So then the entry will just be that you post the depreciation figure, nothing different from what you know. So you're going to debit depreciation expense for that extra depreciation and credit accumulated depreciation, which is in effect, you are crediting non-current asset for the extra, please note, extra depreciation post acquisition. Yeah, so take for instance, if the remaining life of this asset is 3 years, then you know that for the first year, there will be extra of 3/3. There will be extra of 1 million every year that you need to post like this, right? And that will affect your consolidation because your group retained earnings will now be impacted by this debit in depreciation expense. Remember, this is PRL and eventually is affecting your retained earnings. So you need to reduce your retained earnings with that, right? So what I usually advise to do is when you have fair value adjustment, just quickly draw a table and know your acquisition date and reporting date. Right, for your retained earnings. Always use this for retained earnings. So you put what you have on acquisition date before, which is the original retained earnings. Then you put the fair value adjustment, the extra fair value that you're getting. And that gives you your total acquisition retained earnings. Then at reporting date, you have a figure on the financial statement which will be bigger. Remember before, we just do this minus this. However, because there is now fair value adjustment, we can't do that alone. So which means we're going to have some adjustment that has to be done before we can get the total. Then we deduct this from this, whatever we have here. So you start with the reporting subsidiary figure on that day. Then you post the acquisition as well. Yeah, because you need to post on both sides. And if there is even depreciation, right, you also need to account for that. Because take for instance, let me give you an instance. For the first one, without depreciation, it will just be fair value here and fair value here. The same figure will be in both sides. However, if it is depreciable, after the fair value adjustment, there will be depreciation impact. Remember? So you need to take note of that. So which means, yes, we've had fair value increase here. We've had fair value increase here. There's no depreciation here because this is acquisition date. But you need to deduct the depreciation from here because there will be depreciation on the reporting period. Okay? And that will now be a different figure and you have to now deduct that from this. Please, if the asset has been sold before the reporting day, regardless of the scenario, whether it's depreciable or not depreciable, and the rule 2 does not apply because you don't have assets in your financial statement. So if rule 2 does not apply, you don't need to do this rule 2 with interest. It will not be necessary. But rule 1, you still have to do it anyway because rule 1 is about acquisition date. You still need to do that. You need to post the adjustment on acquisition date, which is debiting NCA and crediting retained earnings. Regardless of what happens after, once the item is sold, everything will have been posted and gone into profit or loss account. So it is no more a requirement because the item does not exist on reporting date. Inventory is the next fair value adjustment we'll look at. And this is not any different from what we just looked at on PPE, the non-current asset. There are just few peculiarities around inventory that I'm going to share with you. Remember, when we look at the PPE up there, we said it can be a depreciable item or non-depreciable item. If it is non-depreciable, it is very similar to inventory because inventory is not depreciable as well. So which means depreciation adjustment is not relevant here. Yeah. One thing that will be constant is the acquisition date adjustment. Remember the rule 1, acquisition date adjustment. And because acquisition date adjustment is necessary. Why? Because it's a rule that on acquisition, we must measure at fair value. All asset and liability must be measured at fair value. So that must still going to be done. So inventory will be measured at fair value. So if there's any difference between the fair value of inventory and the carrying value, we must make that adjustment on day 1, that acquisition date. And we're going to be posting entry to debit inventory and we will be crediting retained earnings on acquisition date. Please take note. So this will happen on acquisition date. However, on reporting date, there's likelihood that nothing is going to happen. Remember, inventory is a moving item, so you expect it to have been sold. So most times, nothing is done, because it's sold. So it's just like a non-depreciable item that has been sold. On reporting date, nothing is done. So there's no balance sheet adjustment. There's no adjustment to retained earnings. There's no adjustment to statement of financial position with the carrying value of the inventory. So that is it for inventory. It's as simple and straightforward as that. Another item that we'll look at is liability. Very important. The same principle is applicable here. The popular one you will be given will always be provision. Provision. And this is pretty straightforward. What you need to just check is, what is the question saying? If the question says that, remember, it's still going to be at fair value anyway because it's on acquisition date. But the fair value can be higher and can be lower. If it is higher, it means that there is more provision, so which means more loss. So we're going to be debiting retained earnings on acquisition and crediting provision liability. And if fair value is lower, it means we are happy. So we're going to reduce the provision liability by debiting it, and we're going to have more retained earnings, right? So if provision is higher than we are carrying, what it means is that our net asset will be lower because liability will be up, and vice versa in this case, right? Very important to take note. This is on acquisition, remember. This is on acquisition date. Your adjustment, you need to always consider both acquisition date and reporting date. What happens on the reporting date? We still need to make an adjustment. However, the adjustment now depends on whether the provision has been settled or not. The same way we looked at non-current asset and we say we need to check whether it's been sold or not. If it's been sold, nothing is going to happen on reporting date, but if it was not sold, then we need to make further adjustments. So for liability as well, for provision, if it is sold, then nothing will be done. But if it's not sold, then the same adjustment that we made here, we need to repeat it. So we need to carry it forward to the reporting date. So we're going to do the same thing. Okay? And that is how we're going to deal with provisioning. Very similar to the other ones. It's just about debit and credit, and we will be fine. That's it. Another adjustment that you might be required to make is on contingent liability. This one, I need to put emphasis on this: contingent liability and intangibles. And these are actually very critical items because, normally you are not allowed to recognize these two items in financial statement. They are only disclosure items, right? Contingent liability IS 37 does not allow you to recognize internally generated intangible. That is what this is talking about, the internally generated one. Yeah. Which normally will not recognize. Likewise, IS 38 prohibits recognition of intangibles. Just the same way IS 37 prohibits recognition of contingent liability. However, there's an exception, and this exception is coming from IFRS 3, which says that if there is an acquisition, which is why we are talking of consolidation, in that case, these two guys are allowed to be recognized. So which means you have another rule that I'm saying here. So this is rule 3. Yeah, rule 1 is measured at fair value always. Rule 2, make adjustments to reporting date if the item still exists as a reporting date. And rule 3 is recognize contingent liability and all internally generated intangibles. Yeah, I know you say it's contingent. Yes, it's contingent, but IFRS 3 requires you to recognize it. So must be recognized. So which means you're going to have more liabilities and you're going to have more assets, depending on what the question gives you that this particular entity has. So please take note of that. And it means by the time you recognize all these things, your goodwill will be impacted. So when you are calculating your goodwill, you need to make sure you have made necessary adjustments before you put that into consideration. Yeah, very important. The next adjustment I'm going to touch on now is when you have acquisition during the year. All the things we've been talking about so far, the actions have been taking place in the beginning of the accounting year of the entity, but that is not always the practical situation. Sometimes acquisition can happen during the year. And take for instance, if the financial year of a company is from 1st of March and ends 28th of February, say 2025, that is year end. That is reporting period, which is the financial year. Acquisition can take place anytime. Let's say acquisition date is 1st of July 2024. Where they try to confuse you here is how do you calculate your post acquisition profit? That's all you need to know here. This concept. How do you calculate post acquisition profit? And all you need to do here, it's not difficult. You just need to prorate. So you need to have an assumption in mind that when you see a question like this, you must assume that profit is earned evenly during the year. So there is evenly earned profit. So which means you can just prorate evenly. So for this year, let's say the profit is let's choose a figure. Let me say is 60 million. Yeah. In this case, you need to get your post acquisition profit. And that means that will be equals to 60 million divided by 12 to give you monthly profit multiplied by number of months post acquisition. And in this case, that will be 8 months because you're going to have July, August, September, October, November, December, January, February. So that means we have 8 months post acquisition, and that will give us for year 3, for year 2. So you have 3, you have 20. So that means post acquisition profit is 40 million. So, and this is what we're going to use when we want to calculate the group retained earnings. Remember, group retained earnings is the parent retained earnings plus the proportionate acquisition of post-acquisition profit of the subsidiary, right? So that's where we're going to use it. And I'm going to try all these things when we solve a question. Now, the last part, which I'm going to touch on now, is on consideration. Consideration. Remember, we touched on consideration earlier, and we said consideration is what we pay to acquire. What we paid to acquire. Sometimes it's not just only cash. It can be cash. We can pay in form of shares. We can even pay in form of deferred shares, which means we are not giving the shares now, we are giving it in the future. Or we can also defer the cash, which means we are not paying the cash now. Or we pay cash now, we pay the other one later. So it can be a mix of all of this. It can also be contingent deferred shares. Or it can even be contingent cash. So these are all forms of considerations that any entity can use to acquire a company. And why do you need to know this? You need to know it because you need to add everything together to arrive at your total consideration, which is what you need. Because your total consideration is your cost of investment in subsidiary, which is what you must recognize on day one when you acquire that subsidiary. And depending on the type of form of payment, the measurement will also be different. But what you must do is, the rule is that you must always measure at fair value. So which means no matter how the entity is trying to pay for its acquisition, on acquisition date, your consideration must be measured at fair value. And what I've done is to summarize this in a table for you, which will make life easy for you. These are the types of consideration you can always have: either cash, shares, deferred cash, deferred share, contingent deferred shares. These are different forms, and these are the ways you calculate the fair value. If it is cash, is the easiest one. It's just the cash amount. If it's the shares, the market price is the fair value of the shares. If it is deferred cash, then you need to calculate the present value, and this is the formula you have to use. And if it is deferred shares, market price is what you're going to use. Yeah, because the market price has already determined the present value of the share. So I know it's deferred into the future. However, the market price has helped with the present value calculation. So you don't need to do PV calculation again. And likewise for contingent deferred shares, it's just the same as deferred shares, because whether it's contingent or not, the rule is you must recognize, right? And the entries also varies according to the form of payment. If it is cash, one thing is constant to all of them is always debit in investment subsidiary. You can see it's the credit that makes the difference. For cash, it goes to cash. For shares, it goes to your share price, share capital, and share premium, depending on the amount of price you're paying for, you're issuing the shares for. And for deferred cash, because you are not paying now, so it goes into liability because you're going to pay in the future. And for deferred shares, going to share to be issued reserve account, and likewise the same thing for contingent deferred shares. So those are the adjustments that we have to make, and with that we've really touched on key points. And at this point we should go into question fully. You've learned the 7 steps, you've learned the 5 steps of consolidation itself. We've gone through all the necessary adjustments you need to know: the intragroup transactions, both the balance sheet and the trading part, the fair value adjustment we finished, the forms of consideration we've looked at there, media acquisition we have looked at it. Now let's go into questions, and that will be in the next video. Remember, continue to share, like, comment, and we're on this journey together. Keep going, and thank you for your support. Bye now.